Hey everyone, it's Samples 2, and let's talk about building long-term wealth through smart investments. We're not talking about getting rich-quick schemes, those rarely pan out. We're diving deep into strategies that can help you build a solid financial future. Long-term investing is a marathon, not a sprint. It's about putting your money to work in assets that have the potential to grow over time. Think of it like planting a tree. You nurture it, give it time, and eventually, it bears fruit. That's the power of compounding returns. Over the next few minutes, we'll explore the best investment options available, breaking down their pros and cons, so you can make informed decisions about where to put your money. Remember, the right investment strategy varies from person to person, depending on your risk tolerance, time horizon, and financial goals. Alright, let's kick things off with the big one: stocks. Also known as equities, these represent ownership in publicly traded companies. Now, stocks have historically delivered some of the highest returns in the investment world, but they also come with their fair share of volatility. Think of the stock market like a bit of a roller coaster. It has its ups and downs, sometimes even taking you for a wild ride. But here's the thing. Over the long term, the market tends to trend upwards. That's the beauty of compounding. Even small gains reinvested over time can snowball into significant wealth. Now, you can invest in stocks in several ways. You can buy individual stocks, but that requires a lot of research, due diligence, and a high risk tolerance. For most people, I recommend starting with index funds or ETFs. These offer instant diversification by tracking a specific market index like the S&P 500, spreading your risk across hundreds of companies. And hey, if you're looking for a steady stream of passive income, dividend stocks might be your thing. These are companies that share a portion of their profits with shareholders regularly. It's like getting paid just for owning a piece of the company. But remember, stocks aren't without risk. Market volatility can be unpredictable. Individual companies can struggle, and even the entire market can take a hit. That's why diversification, a long-term perspective, and investing consistently are key. Next up, let's talk about bonds, the more stable, predictable, older sibling of stocks. Bonds are like loans you give to governments or corporations in exchange for regular interest payments and the eventual return of your principal. They typically offer a fixed income stream, making them a popular choice for investors seeking stability and lower risk compared to stocks. There are different types of bonds to choose from, each with its own risk and return profile. You've got government bonds, considered the safest since they're backed by the government. Municipal bonds fund state and local projects, often offering tax advantages. Corporate bonds are issued by companies, and their risk and return depend on the company's financial health. Then we've got Treasury inflation-protected securities, or TIPS for short. These bad boys adjust their principal and interest payments based on inflation, providing a hedge against rising prices. While bonds are generally considered less risky than stocks, they still come with their own set of risks. Interest rate risk is the big one. When interest rates rise, bond prices tend to fall, and vice versa. Another risk is credit risk, particularly with corporate bonds. There's a chance the issuer might default on their interest payments or principal repayment. That's why it's crucial to diversify your bond holdings, just like you would with stocks. Let's be real, who hasn't dreamt of owning a piece of the pie, literally? Real estate is a tangible asset that's been a cornerstone of wealth building for generations. It offers the potential for appreciation, rental income, and even some sweet tax benefits. Now, when it comes to real estate investing, you've got options. The traditional route is buying rental properties. You become a landlord, collect rent, and potentially benefit from property value appreciation. It can generate passive income and build long-term wealth, but it also requires capital, managing tenants and handling property maintenance. If being a landlord isn't your cup of tea, don't worry. You can invest in real estate investment trusts, or REITs. These are companies that own, operate, or finance income-generating real estate. Think of it like buying shares in a shopping mall or an apartment complex. REITs typically trade on stock exchanges, offering liquidity and diversification. And for those looking for a lower barrier to entry, real estate crowdfunding platforms have popped up, allowing you to invest in various real estate projects with smaller amounts of capital. But just like any investment, real estate has its risks. Market fluctuations can impact property values, interest rate hikes can make mortgages more expensive, and unexpected repairs can eat into your profits. It's essential to do your due diligence, research the market, and invest wisely. Chapter 4. Mutual funds and ETFs, investing made easy, sort of. Let's face it, researching individual stocks can feel like a full-time job. That's where mutual funds and exchange-traded funds, or ETFs, come in to save the day. These investment vehicles pool money from multiple investors to invest in a diversified portfolio of assets, such as stocks, bonds, or even real estate. One of the most significant benefits of mutual funds and ETFs is instant diversification. Instead of putting all your eggs in one basket, you're spreading your risk across hundreds or even thousands of securities. Plus, they're managed by professional portfolio managers, in the case of most mutual funds, who make investment decisions on your behalf. There are tons of mutual funds and ETFs out there, catering to different investment styles, sectors, and risk tolerances. You've got index funds that passively track a specific market index, like the S&P 500 or the NASDAQ 100. Growth funds focus on companies with high growth potential, while dividend funds prioritize stocks that pay dividends. But it's important to remember that while diversification can reduce risk, it doesn't eliminate it entirely. Market downturns can still impact your investments. Plus, some mutual funds, particularly actively managed ones, come with higher fees that can eat into your returns over time. It's essential to carefully consider the expense ratios and historical performance of any fund before investing. Chapter 5. Retirement Accounts. Securing your financial future, one contribution at a time. Alright, let's talk about the future. Your future. Retirement accounts are like the superheroes of the investment world, specifically designed to help you save for those golden years. They come with a cape of tax benefits, a shield of employer-matching contributions in some cases, and the power of automatic investing. The most common retirement accounts are 401ks and individual retirement accounts, or IRAs. With a 401k, you contribute pre-tax dollars, which lowers your taxable income today. Plus, many employers offer matching contributions, essentially free money. IRAs, on the other hand, offer more investment choices and can be opened by anyone, regardless of employment status. Now, within IRAs, you've got traditional and Roth options. Traditional IRAs offer tax-deductible contributions, while Roth IRAs provide tax-free withdrawals in retirement. The best choice for you depends on your current income and tax bracket. But remember, retirement accounts come with some rules and restrictions. Early withdrawals before age 59.5 are generally subject to a 10% penalty. Plus, you'll owe taxes on the withdrawn amount. Plus, some retirement plans have limited investment options, potentially restricting your ability to diversify as much as you'd like. It's crucial to familiarize yourself with the specific rules and contribution limits of each retirement account to maximize your savings and avoid any surprises down the road. Let's dive into the exciting world of commodities. We're talking about raw materials like gold, silver, oil, natural gas, agricultural products, the stuff our world relies on. Investing in commodities can be a way to diversify your portfolio and potentially hedge against inflation. See, when inflation rears its ugly head, the prices of goods and services tend to go up. And guess what? Commodities are often the first to feel the heat. So, by investing in commodities, you're essentially betting that their prices will rise alongside inflation, preserving your purchasing power. Now, you can invest in commodities in a few ways. You can buy physical assets like gold bullion or silver coins, but that comes with storage and security costs. Or, you can invest in commodity ETFs, which track the price of a specific commodity or a basket of commodities. These offer an easier and more liquid way to gain exposure to the commodity market. But, hold your horses. Commodities can be highly volatile, subject to wild price swings due to factors like supply and demand, geopolitical events, and even weather patterns. Plus, unlike stocks or bonds, commodities don't generate passive income. They're purely a play on price appreciation. So, if you're considering adding commodities to your portfolio, proceed with caution and make sure you understand the risks involved. Alright, thrill seekers, this one's for you. Alternative investments are like the adventurous, high-risk, high-reward cousins of traditional investments. We're talking about things like private equity, hedge funds, venture capital, and even cryptocurrency. Now, alternative investments have the potential to generate substantial returns, often outperforming traditional assets in certain market conditions. They can also add diversification to your portfolio since they tend to have low correlation with stocks and bonds. In other words, when the stock market zigs, alternative investments might zag, potentially smoothing out your overall portfolio returns. But here's the catch: alternative investments often come with high minimum investments, limited liquidity, and a lack of transparency. They're also less regulated than traditional investments, which can increase the risk of fraud or mismanagement. Take private equity, for example. It involves investing directly in private companies or buying out public companies to take them private. The potential returns can be enormous, but it requires significant capital, a long time horizon, and the ability to stomach potentially illiquid investments. Hedge funds, on the other hand, use advanced investment strategies, often involving high leverage and short selling, to generate high returns. They're open only to accredited investors, meaning you need a certain level of wealth and sophistication to participate. And then there's cryptocurrency, the wild west of the investment world. While digital currencies like Bitcoin and Ethereum have skyrocketed in value, they're also notoriously volatile and subject to regulatory uncertainty. The bottom line is, alternative investments can be a powerful tool for sophisticated investors seeking diversification and potentially higher returns, but they're not for the faint of heart. It's crucial to thoroughly research any alternative investment, understand the risks involved, and consider whether it aligns with your overall investment goals and risk tolerance. Alright, let's bring it back to basics with a safe and secure investment option: U.S. Treasury I-bonds. These bonds are like the reliable, inflation-fighting superheroes of the fixed income world, issued by the U.S. Treasury. The beauty of I-bonds is that their interest rate adjusts with inflation. So when inflation rises, so does the interest you earn on your I-bonds. This makes them an excellent option for preserving your purchasing power and protecting your savings from the erosion of inflation. Plus, I-bonds offer tax advantages. The interest earned is exempt from state and local taxes, and you don't have to pay federal income tax on the interest until you redeem the bond. Talk about a win-win. However, I-bonds do have some limitations. First, there's an annual purchase limit of $10,000 per person. Second, you can't redeem your I-bonds within the first 12 months of ownership. And if you redeem them before 5 years, you'll forfeit the last 3 months of interest. While the interest rates on I-bonds adjust with inflation, they might not always keep pace with the returns offered by stocks or other higher-risk investments. But for those seeking a safe and guaranteed way to protect their savings from inflation, I-bonds are a solid option. So there you have it, a rundown of some of the best investment options for building long-term wealth. Remember, the right strategy for you depends on your individual circumstances, risk tolerance, financial goals, and time horizon. A well-balanced approach often involves a mix of asset classes such as stocks for growth, bonds for stability, real estate for passive income, and potentially a sprinkle of alternative investments for diversification. The key is to find the right balance that aligns with your investment objectives and risk appetite. If you'd like personalized guidance on crafting an investment strategy tailored to your unique needs and goals, don't hesitate to reach out. I'm here to help you navigate the world of investing and make informed decisions to secure your financial